Welcome back, traders and investors. Our final guest of the day is Eric Marshall. Eric is co-portfolio manager of the Hodges Small Cap Fund. He is the president, portfolio manager, and director of research. Eric, how you doing this morning?
We're doing great.
Okay, well, the S&Ps are trading up almost 9 points, coming up on their all-time high, 1978 and a quarter. But you're a small cap kind of guy. Why do you choose to focus on the small caps?
Well, I think right now is really a very interesting time to be looking at small cap stocks because it's probably the area of the market where you can find the biggest disconnects and the most inefficiencies to take advantage of. And, over the last couple of years, there's been so much emphasis on exchange-traded funds and index investing, and people have really ignored a lot of the smaller stocks from a research perspective, and you now have fewer and fewer analysts out there actively managing portfolios and really going out doing deep dive research on small companies. So it's really created a great environment for small, actively managed small cap mutual funds to go out there and really be rewarded for doing deep dive bottoms up research.
And give us your definition of a small cap.
Well, we defined small cap as the universe of the Russell 2000. So at the time that the Russell most recently rebalanced, June 30th, the biggest stock in the Russell was about $4 billion in market cap. So anything below $4 billion, we will categorize as a small cap stock. But within our fund, you would find companies that were, 200 million, 300 million, but also things that were much, much larger than that.
And once they get over that threshold, do you hold on to them? Do you look to exit them to put your money somewhere else?
Yeah, we do. We think it's important to let your winners run, and the mandate of the Hodges Small Cap Fund and the Hodges Small Intrinsic Value Fund, it's a newer value small cap fund that we launched earlier this year, is that we have to keep the funds 80% within small caps, and that 20% allows us to hold on to some of our winners. So the really good small cap companies, as they execute their growth plans and they see their market caps rise, we will hold them into, becoming mid caps. And as long as we see more upside potential than downside risk, we're going to hold on to the name. And I think that's been a real key to our success here over the last few years.
A key to anyone's trading success, letting your winners ride and cutting your losers. Definitely a strategy we all should employ more. Let's talk about that Russell rebalance on June 30th. I don't have all the issues in here that I covered, but holy smokes, some people just got taken out to the cleaners in that. Stocks that were getting added went down. Stocks were getting taken out went up. Did you play it? And if so, you have to play it. How did you do on that?
Well, I think it's the one time a year that that people are buying and selling for reasons not tied to the company fundamentals. So it's the one time we get people selling stocks or buying stocks for reasons completely unrelated to the earnings and cash flow and intrinsic values of the businesses underlying those stocks. So I think if you really do your homework and you know what you're buying, you can create opportunities to buy things that are maybe getting excluded from the Russell, or sell things that may become overvalued just because they've been added to an index because their stock market cap hit a certain threshold to be added to that index. So it's the one time a year that that there's non-fundamental trading going on, and if you really zone in on what's going on with the companies you're investing in, almost like a private equity investor in the public market, it can create opportunities. So we did add to some things, and we did trim back some things in our portfolio as a result of that.
Do you mind discussing what you added and what you trimmed?
Really, we can't until the end of the quarter.
Okay, all right, but but you weren't wedded to the to certain stocks just because of following the small caps. You didn't have to do the exact taking in and taking out that accordance with the index, right? You still just traded things according to your model.
Right. Well, we're trading things based on what we think the companies are worth.
Right.
So we
Okay.
have about 80 stocks in our small cap core mutual fund. We have less than that in our. We're a little bit more concentrated in the Hodges Small Intrinsic Value Fund. But we're basically thinking of ourselves like private equity investors in the public market. So when we're buying or selling something, we're looking at what is the underlying value of the business, what type of earnings power does that company have over the long run, what type of underlying value, replacement value of the assets and future cash flows, and what all those are worth to make our decision whether or not to buy something or sell something in the portfolio. And oftentimes index rebalancing and stuff like that, or really just ETF fund flows can create inefficiencies in that type of market.
Is there options on many of these small cap stocks?
There are, but we tend to be longer term investors, and we don't really do a lot with the derivatives into things.
Okay, you've talked a lot about your affinity for fundamental analysis. Do you pay any attention to the charts?
I think we, make our decisions based on the fundamentals, but we will pay attention to the technicals whenever we're entering or exiting a position. It the technicals will tell you kind of what the current supply and demand is out there for a particular stock that you may be buying and selling. So we will listen to it, and it may affect our timing of when we and how we enter or exit a position, but we very rarely will go buy something or sell something because of the technicals themselves. We think of it more as a kind of a short-term trading tool in executing our core fundamental strategy.
Okay. And there's obviously different sectors, within the small caps in and of itself. I know you can't mention individual stocks, but do you see, any particular sectors that are kind of heating up and perhaps some that are cooling off?
Well, I think the one thing when you look out there in the small cap universe, it's a very broad market, and there are some areas that look more expensive than others right now. And where we're finding opportunities are things like manufacturing, some of the transports. We like some of the domestic energy stocks out there, certain pockets of technology that we like. And we're really attracted to companies that are exhibiting pricing power. And we're definitely seeing that with some of the industrial companies, where companies are raising prices, passing on inflationary cost pressures. Whenever you get price increases, you tend to get profit margin expansion, and that is a key driver for earnings. And usually earnings increases also and wider profit margins usually create P multiple expansion as well. And when you get earnings going up and multiple expansion at the same time, you tend to get the biggest moves in stock prices. So pricing power is something we really pay attention to, and those are some of the sectors that we like right now.
Okay, things that have pricing power. A lot of people tend to say that the Russell and the small caps kind of lead the overall market. And if you're banking on that analysis here, the small caps have topped out here, and they're nowhere near their all-time highs here. So, do you think this is indicative of the overall market, or do you think that the small cap's going to catch up with the broad market?
Well, I really think to some degree the broader market is catching up with the the bigger stocks are catching up with the smaller stocks. Small caps have really, if you look at the previous 5 years, have really outpaced the S&P 500 if you compare it to the Russell 2000. And I think that with the market near 52-week highs, it's more and more important to pay attention to valuations, fundamentals within the Russell. Like I said, there are areas that we think are very undervalued. There are areas that look very expensive. So I would say within the small cap space, you really need to focus on individual stock selection and not just broadly, buy the entire market in the form of an ETF.
And do you have I know you're not huge on the technicals, but do you have a technical level in the Russell that if it breached that level might kind of change your long-term opinion?
We really don't. And when we look at technicals, we're really looking at the technicals for individual stocks, less, paying attention to what's going on with, the broader index technicals. And, we think of ourselves, like I said, we're investing in in stocks, not in the market itself.
And how long have you been focusing on the small cap sector?
I've been here with Hodges for the last 17 years and co-managed the small cap fund since its inception. But Hodges has been, since it was founded in 1989, has really had core research competencies in doing bottoms-up fundamental research of small and mid-sized companies.
All right, so 17 years in the market, you've seen the ups, you've seen the downs, you've seen the sideways here. Do you feel that we're in any kind of bubble territory here?
I don't think so. I don't think that you've seen the excesses. I could sit here and look at many things that are still trading at 13, 14, 15 times earnings. Yeah, there's some parts of the market that you see, stocks that are trading at a little bit higher multiples than where they have historically, and that raises some caution in certain areas. I think especially in some of the really fast-growing areas of social media and biotech and stuff like that, you really can find some things where you kind of scratch your head a little bit, but you really haven't had the euphoric, really high valuations that normally you would see in a market bubble or at the peak of a market. I think that, having periodic corrections in the market is actually a healthy thing. Having 5-10% corrections within a healthy bull market is actually good because it does keep valuations in check. It keeps investor sentiment from getting carried away, and it keeps those bubbles from forming. So having sell-offs like the one that we've had here over the last couple weeks is actually a normal, healthy thing for the market.
And if an investor, let's say they have primarily a large cap and a mid cap, portfolio, really don't know too much about the small caps, how would you encourage them, and what way would you encourage them to learn about small caps?
Well, I think, just having a natural curiosity of what's going on around you and, going out and reading a lot and paying attention to the, what's going on around you from a consumer standpoint, from what's going on in your town or community, I think is relevant, kind of the Peter Lynch type approach. But if you don't have the time to go out and do, the deep dive fundamental research in small cap companies, which is, there's less and less people doing it, and it's very time intensive. I think looking at an actively managed mutual fund is really the best approach to small cap investing for the average investor out there.
Okay, all right. We've had Eric Marshall on the line, co-portfolio manager of the Hodges Small Cap Fund, giving us a in-depth look at the Russell Index and his strategies, fundamental and not really technical approach to the markets. Eric, thanks for taking your time out to come on the show this morning. We'd like to have you on again.
All right. Thank you.
Okay, thank you, Eric.